Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Wednesday market webcast. All right, so yesterday was CPI. Today is the Fed. The CPI pop up to 4180 was rejected. They brought it back in. On the continuation chart, they didn't hit the 20-day and the 9-day. What I'm going to show you real fast, I don't normally do this, which is that on the front month, they pop it, they hit the third standard deviation band, that got fully rejected, back into daily mid-band and the 9-day, which then held as support. So you get in here, and I'll put it up on the hourly. CPI pop, rejects, daily mid, which is a green line, 9-day, holds, okay? They bring it up a little bit, tightens up the bands again. Overnight was pretty boring. And now we have the Fed. So who won yesterday? I mean, I guess you have to say the Bears, although I have a tremendous problem when you are rejecting as hard as you rejected yesterday from the third standard deviation band, and you get down to the middle band of the 9-day as early in the day as you did. This is the 12 o'clock hour. Regular session closes at 4, at least at my house. So you had a solid 4 hours to deal with the 9-day, the 20-day, weekly pivot, all of it, and you let them hold it as support. So now we're up here, messing around with 40-50 again, and with a big data point. So I don't expect a truckload of volatility before 2 o'clock. We'll see what the Fed wants to do, what they don't want to do. I think it's 50 basis points, not 75. I think yesterday probably put that pretty solidly in the reality section of the day. Volume weighted average price is sitting at 57. Hourly mid-band is sitting at 58.71. Just be very mindful of the reaction range from the Fed and that being broken out or broken down from. I wouldn't try to game this Fed number any more than I'd want to try to game the CPI number. So, they take CPI from 40.50 to 41.80. They come back and through. It's a hell of a lot easier to get the hell out of the way of the early CPI stuff, figure out what it wants to do. We ended up centering everything right around 41.40, long above, short below, and we ended up in a really nice move down. And then we did it again from 30 off the pop, and that was an even better move down. So, you don't have to be there. The point I'm trying to make it's not, oh, what a great trade. The point I'm always trying to make with you guys is you don't have to guess which way this stuff is going to go, and you don't have to go 30, 40, or 50 in the hole trying to sort out which way it's going to go and potentially nuke yourself to get into a good trade. Let these numbers happen. Let the reaction range develop and trade off of that. So off the open, you're really dealing with the Globex low, which is down in the 44 area, up to 40.60. If there is a positive reaction to the Fed, I am going to be looking long and hard at 41.80 because what we've seen out of CPI for the past few numbers is you have seen significant lows made and then held as time goes forward, okay? 35.02, I think it was. There was a couple other ones. If now, with the headline number on CPI cooling rather than heating up inflation-wise, are we going to start to see CPI reaction numbers mark highs in the tape? I don't know. We're going to find out. If that starts to happen, then what you're going to get December into January is a massive 400, 500, 600, 700 handle triangle that we're all going to be able to trade in between, and more likely than not, there'll be plenty of elbow room to get done what you need to get done in there. Although I do expect December to slow a little bit after we sort out what today wants to be. Unless there's another, there's all kinds of shoes around the world that can drop. But this is another big unknown today that we need to get off the table. Don't game it. Trade the reaction range. Respect risk. Okay? All right, I'm going to shut up now because market opens in about 15 and I want to get this out. Everybody have a fantastic day. Be safe, be healthy, take care, trade them well. I'm back tomorrow and I'll talk to you then.